Hi, everyone. Thanks for joining us today, a fine Tuesday afternoon. Jeff and I are going to go over and discuss some interesting, facts about owning money market versus GICs and possible rotation back into equities.
Yeah.
So let's get started.
Yeah, if you look at the money market fund investment throughout the United States, it's gone significantly higher since rates were elevated in February, March of 2022. Right
Yeah,
now, there's about uh $6.5 trillion in money
right.
market funds.
Yeah. And
And
that's
that's
including the 1.5 trillion since 2022.
Yeah, right. So since the rates went up, there's an extra 1.5 trillion that's gone into money market funds. And as rates go down, we're thinking that that 1.5 trillion might come out of the money market funds back into dividend paying stocks. And that's very buoyant for those names. Just to put 1.5 trillion into perspective, that's about 3% of the S&P 500. So it's pretty big.
Yeah, yeah. And then when you look at the bond market versus the equity market, the bond market is what, 300 trillion versus 101 to 108 trillion
Mm.
equity market.
A bill,
Substantial.
A billion here, a billion there, who's counting? No, you're right. The
Yeah.
point is the bond market is so much bigger than the stock market. And it depends how you calculate it, but if you
Hmm.
look at global bonds versus global stocks, global bonds are about 3 times as big as global stocks. So any kind of rotation would be very meaningful for anyone who owns stocks. And that's what we
Yeah.
want for clients.
So it should be interesting because I guess the interest rates are starting to stabilize. There's going to be less, interest rate uh, a slowdown, and that'll mean that there will be some rotation out of money market fund or debt
Yeah.
products back into the market.
Yeah, I mean, I think as rates go down, a lot of people will say, hey, I really like this income that I was getting, but I'm no longer receiving in the future. So what can I buy to keep getting that income stream?
Yeah. But it is really important to have the money market, especially baby boomers. Anyone born between 1946 to what is it, 1964. So you're looking at an age group of 60 to what, 78?
Wow.
Yeah, so
78.
once you hit 71 plus, anyone that's got the retirement income fund, right, need the income stream. They have to start withdrawing it after their 71st year. So the flexibility of owning the money market is a positive thing. Having money market as an emergency fund, not
Yeah,
necessarily a
sure.
retiree, but an emergency fund is a necessity. It's a good thing. And a money market pays higher than a GIC.
For
Like
now.
our, yeah,
Yeah, but those
for
rates
now.
are going down though. And I
Right.
think if you're a retiree and you require the income, it provides you with good stability.
Hmm.
I think it also depends how much money you have. Like
Right.
if you're
For
just on
sure.
the fringe and you really need the income next month, I would hang on to it.
Right.
But if you're somebody who's above and beyond your minimum expenses, you know, I
Hmm.
would move into the dividend paying stocks.
Yeah.
We had a
Most
call
of
with
it,
a
but I,
we had a call with a client. I won't say anything personal, but listen to these numbers. So this lady, who's a great friend of ours, started with us. She had $4.8 million. That was when we got registered in February of 2022. She's now got 7.2 million.
hmm.
So, I mean, she doesn't need a money market fund.
No.
She wants the dividend payers
Right.
because she could get upside on the stock too.
Right.
And So I
So
think
why
it
don't we
will,
go through, well, Jeff, why don't we go through some of those reasons of why it might rotate from money market funds into equity dividend paying stocks?
sure. And you've got your dog in the
I do,
background.
I'm sorry.
No, 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 that's okay.
It's yeah,
Just
bewitching hour when all the kids get out of school.
that's okay. Let's go through
Yeah.
reason number one.
Pardon?
Go through reason number one.
Okay, well, I'll just okay, so let's go through some of it right now. Interest rate stabilization.
Okay, so I think if rates go down, why would you want to own a money market fund or a GIC? If you're getting, say, 4.5%, 5%, you like that, that's great. But you're
Hmm.
not going to get that in a year from now because rates are going to be lower. So if you, let's say you've got a GIC that's paying 4.5, it's going to mature sometime this fall. A year from now, it might be paying 3.5. We're
Yeah.
buying stocks right now that pay a dividend of 4, 5, 6%. There's one stock we're thinking of adding to tomorrow that pays an 8.5% dividend yield.
Right.
So
Yeah.
you get the
It's huge.
dividend plus the upside on the stock, as long as you've got a long enough time horizon.
Right. Okay.
So
Well, that's a good reason.
yeah.
Okay, so another one, let's just go through a couple
Yeah,
of
yeah,
them.
sure.
Market sentiment and momentum. So the psychology behind investing, the positivity of having media, news, earning reports, all the positive, economic data, geopolitical developments, all rolled into one, all positive.
Okay, so I can tell you that if you study historical markets, there's always something to be worried about. Always, okay? Right now, there's an election coming up in 3 weeks. It will be
Mhm.
over, and the market just wants to know who wins. So there will be a victor, and then we move forward to the end of the year. Right now, corporate earnings look pretty good. Rates are going lower. It's a decent environment. There's concerns in the Middle East, but there are always concerns whenever you're investing. So I think that sentiment is right now it's very high because the market is elevated. But it's a good environment for owning stocks, particularly
Mhm.
because rates are going down.
Yes. Okay, one more we'll touch on.
Sure.
Okay, let me see which one. Well, we can look at corporate earnings growth. It's easy.
Yeah, I mean, earnings growth, it's supposed to be about 4% this quarter and it's to be double digits next year. Honestly, I don't pay much attention to that because analysts are always very bullish. There's a huge conflict of interest. If you own mutual funds with a bank, watch out because there's a huge conflict between the investment banking arm of a big financial institution and the wealth management side because on the investment banking side they always want to pump up the stocks that they're covering because they get paid for issuing bonds or stock, and then in turn their wealth managers will buy it for their clients. We don't have any of those conflicts, so we just look at things as they are.
Hmm.
um, so I wouldn't pay much attention to that at all, but I do think that earnings will be higher next year than they are today. And one of our stocks, which is called Charles Schwab, reported earnings this morning. They benefit most of all the stocks we own for clients. We own about 25 of them. Schwab benefits most when rates go down because the problem they've been plagued with the last year or so is that people are moving their cash into higher yielding securities. And they've now seen that plateau and foresee better days ahead. So the stock's up about 7% today. We bought it during the Silicon Valley Bank crisis. I think we purchased it at around $56 a share.
Hmm.
And today it's 72, 73. So we're up about 30%. So I'm happy about
Nice.
it. But
Yeah.
we're not going to sell that one for the reasons we've discussed in this webcast.
Hmm. Okay. Anything else you want to discuss?
Nothing to add.
Okay. All
Okay,
right, thanks,
take care of
Jeff.
that dog, would you?
I know. He settled down. We're good.
Okay. Okay, Sunny. See
Okay,
you next
talk to you
week.
later.